Okay? So you think Red Bull sells an energy drink. You see the blue and silver cans in every gas station and gym. You see it on every F1 grid, every skate park, every dorm fridge. You figure it's caffeine, sugar, and a clever slogan. Somewhere in that can, billions of dollars materialize. Simple, obvious, a caffeine empire. Here's what's actually happening. The liquid inside that can cost roughly 30 to 50 cents to produce, retail price runs $2 to $3 a can, sometimes higher. That gap is not an accident, it's the entire business. Because Red Bull is not really in the beverage business. It never was. The story starts in Thailand, not Austria. In the 1970s, a pharmacist named Chaleo Uvidya created a tonic called Krating Deng. The name translates roughly to red gaur, a wild ox. It was cheap and popular with laborers and long-haul truck drivers. It gave working people a jolt to survive brutal double shifts. It wasn't carbonated, and it wasn't marketed as premium at all. In 1982, Austrian marketing executive Dietrich Mateschitz tried it on a business trip. It cured his jet lag, and it planted an idea. There was no real energy drink category in the West at all. Mateschitz saw an entire untapped market hiding inside a cheap local tonic. Mateschitz approached Chaleo, not to buy the formula but to partner. In 1984, they formed a joint venture, each side putting in a small stake. The initial capital contribution from each side was famously modest. The split was 51% to Chaleo's family, 49% to Mateschitz. That ownership structure still exists today, virtually unchanged. Mateschitz spent 3 years reworking the syrupy Thai formula for Western tastes. He added carbonation, cut the sweetness, and rebuilt the brand from scratch. In 1987, Red Bull launched in Austria under a completely new identity. It wasn't sold as a cheap laborer's tonic anymore. It was sold as premium, edgy, and slightly rebellious. The can design itself, tall and slim, looked nothing like a soda can. It looked more like a battery than a beverage. The product barely changed. The story around it changed completely. The drink was never the invention, the positioning was. Red Bull entered the United States a decade later, in 1997. Within its first year, it captured roughly 75% of the American market. There was almost no real competition for that category yet to fight off. Red Bull is not selling you caffeine and taurine. It is selling you identity, adrenaline, and belonging to a tribe. It uses a can of liquid as the delivery mechanism for all three. The slogan itself tells you everything. It gives you wings. Not electrolytes, not focus. Wings, an emotional promise, not a nutritional claim. Nobody buying a Red Bull at 2 a.m. is reading the ingredient label. They are reaching for a feeling, urgency, momentum, an edge. Unlike Coca-Cola, Red Bull never built a global bottling franchise network. Instead, it kept production tightly controlled through a small number of contract manufacturers. Its longtime primary bottling partner, Rauch, is based in Austria. The company keeps the recipe, the brand, and the marketing engine in-house. It doesn't own most of the factories or trucks moving product into stores. What it owns is far more valuable, the meaning attached to the can. If a competitor copied the formula tomorrow, it still wouldn't win. Red Bull didn't build a drink category, it built a mindset. Now here's where the business gets genuinely strange and genuinely brilliant. Red Bull spends roughly $3 billion a year on marketing. Close to half of that goes directly into sports sponsorship. Not TV commercials about taste, sponsorship of actual athletes and events. The company sponsors more than 600 athletes worldwide. It owns 2 Formula One teams outright, Red Bull Racing and Racing Bulls. It owns football clubs, RB Leipzig, FC Red Bull Salzburg, the New York Red Bulls. It also owns a Brazilian club, Red Bull Bragantino. It funds cliff diving, freestyle motocross, BMX, and big wave surfing. It runs Red Bull Air Race, a motorsport series flown through the sky. It runs Red Bull Flug Tag, where amateurs launch homemade flying machines off piers. None of these events are subtle, and that's entirely the point. In 2012, it funded a stratospheric skydive called Red Bull Stratos. Felix Baumgartner jumped from the edge of space and broke the sound barrier falling. Roughly 8 million people watched it live, a record at the time. Not 1 second of that footage sold a drink directly, but it made the brand feel mythic, which advertising rarely manages. Red Bull doesn't think of itself as running a marketing department. It runs something closer to a media company that happens to sell drinks. Red Bull Media House produces films, magazines, and broadcast content year-round. Publishes the Red Bulletin, a print and digital lifestyle magazine. It runs Red Bull TV, a free streaming platform built entirely around its content. It even operates Red Bull Records, signing musicians outside the energy drink space entirely. None of it looks like a traditional advertisement. All of it reinforces the same idea: intensity, extremity, adrenaline. A viewer watching a cliff diving video isn't watching an ad. They're consuming brand content voluntarily, a much stronger form of exposure. Traditional advertising interrupts what you're doing. This content becomes the thing you're doing. That distinction is worth billions in earned attention every year. Sponsorship payments to athletes alone crossed €1 billion back in 2022. That number has almost certainly grown since. It sounds like an enormous expense, and it is. But look at what it actually buys. Decades of authentic association. Every extreme sports highlight reel becomes a Red Bull commercial. Nobody skips. Compare that to a 30-second TV spot people mute or scroll past. The return isn't measured in a single campaign. It's measured in a permanent cultural association most competitors can't afford to build. Monster and other rivals compete mostly on price and shelf space. Red Bull competes on meaning, and meaning is much harder to copy. Now let's talk about the numbers, because they're genuinely enormous. In 2024, Red Bull posted record net sales of €11.2 billion. That was a 6.4% increase over the year before. It was also the slowest annual growth rate the company had seen in 4 years. The company sold 12.7 billion cans worldwide that year. It now operates in 178 countries. Headcount crossed 20,000 employees globally, adding roughly 2,000 jobs that year alone. In 2025, revenue climbed further, past €12 billion. Cans sold reached nearly 14 billion units in a single year. That's roughly 440 cans sold somewhere on Earth every single second. This is still a privately held company, not traded on any stock exchange. That means no quarterly earnings calls, no shareholder pressure for short-term results. Ownership sits exactly where it did back in 1984. The Uvidya family holds 51%. Mark Mateschitz, son of the late founder Dietrich, holds 49%. Dietrich Mateschitz passed away in 2022. His stake and control of the company's direction passed to his son. In 2024 alone, Mark Mateschitz collected a personal dividend near €400 million from a business that started as a partnership with almost no capital. Now let's look at the unit economics, because they explain the whole machine. A single can cost roughly 30 to 50 cents to manufacture. It typically sells for $2 to $3 at retail. That's a gross margin most consumer goods companies would kill for, and they multiply that margin across nearly 14 billion cans a year. The scale turns small per-can profit into staggering total profit, and because the sponsorship spending builds brand value that compounds over decades. The company doesn't need to reinvent its pitch every single year. It just needs to keep showing up at the edge of what's possible. Red Bull has always priced itself as a premium product, never a bargain one. An 8.4 ounce can cost more per ounce than a full soda. That's deliberate, not accidental. A cheap price would undercut the whole positioning the brand spent decades building. Nobody associates cheap with wings, edge, or extremity. The price itself is part of the marketing. Consumers pay the premium because the story justifies it in their mind. That's pricing power built entirely on perception, not on ingredients. The company also expanded its product line to defend that pricing power. Red Bull sugar-free and Total Zero target health-conscious buyers without losing the ritual. Limited flavor editions, silver, blue, red, keep the lineup feeling fresh. None of these variants change the core formula economics much at all. They simply give the same margin structure more shelf space to occupy. Traditional advertising has a shelf life, A campaign runs, then it fades. Sponsored athletes and owned sports franchises generate content indefinitely. Every race Red Bull Racing wins is free global media coverage. Every jaw-dropping stunt clip gets shared organically for years afterward. The marketing doesn't decay the way a TV spot does, it compounds. Owning an F1 team also buys something advertising money can't buy directly: legitimacy inside a sport, not just a logo slapped on the outside of it. Max Verstappen's championship runs generate headlines no billboard ever could. None of those headlines mention taurine or sugar content once. They just repeat the brand name over and over inside a winning story. The second F1 team, Racing Bulls, effectively functions as a driver pipeline. It develops young talent before they're promoted to the senior team. That's a sports strategy borrowed directly into a marketing budget. Now consider what happens when a competitor tries to copy this model. Building a new energy drink formula is relatively cheap and fast. Building 600 sponsored athletes and 2 F1 teams is not. It would take a rival decades and billions of dollars to catch up. Even then, they'd be copying a strategy, not the cultural head start. That head start is the actual moat, not the caffeine formula. Anyone can chemically analyze a can of Red Bull today. Nobody can quickly replicate 40 years of extreme sports credibility. There's also a quieter financial discipline running underneath all this spectacle. The company has stated its growth is financed from operating cash flow, not from external debt piled onto a private balance sheet. That means the marketing machine largely pays for itself. Sponsorship spending isn't funded by loans betting on future growth. It's funded by cans already sold at very healthy margins right now. A downturn doesn't leave Red Bull exposed to a debt spiral. It just means marketing budgets flex a little with cash flow that year. That structure is unusual for a company running events this expensive. Most rivals with similar ambitions rely far more heavily on outside financing. Now let's talk about competitive pressure, because it has grown significantly. Monster Energy has closed the gap in several markets, including the United States. Celsius and other fitness-oriented brands have carved out their own loyal niche. Dozens of private label and regional energy drinks now crowd the shelf. Red Bull's growth rate has slowed compared to its earlier decades. 2024's growth was its slowest pace in roughly 4 years. That's not collapse. That's a maturing category with more competitors in it. The company's response wasn't to cut marketing, it was to expand it. More athletes, more events, more owned sports properties, not fewer. In a crowded category, brand depth wins. A generic energy drink competes on price per can. Red Bull refuses to compete on that battlefield at all. It keeps competing on meaning, on spectacle, on cultural ownership. That's a much harder fight to win, and a much harder one to enter. A beverage company optimizes for taste, cost, and distribution efficiency. Red Bull optimized for something almost nobody else was even measuring: attention, adrenaline, and the feeling of being slightly outside the mainstream. Every dollar spent on a stunt or a race is really a media investment. It just happens to be paid for with energy drink margins. A cheap-to-make caffeinated drink funding one of the largest sports media empires alive. And that media empire, in turn, keeps the drink desirable and premium. It's a closed loop, and it's been running for almost 40 years. There's also a generational dimension to this that matters a great deal. Every teenager who grows up watching Red Bull content becomes a lifelong customer. The brand doesn't need to win them over later, it wins them early. By the time they're old enough to buy their own groceries, the habit exists. That's the same emotional wiring soda brands spent a century building for themselves. Red Bull compressed a version of that timeline into roughly 4 decades. So what does the future likely look like from here? In the optimistic case, emerging markets keep adopting energy drinks at pace. India, Brazil, and Eastern Europe have already posted strong double-digit growth. Sponsorship investments keep compounding into deeper cultural ownership of extreme sports. Pricing power holds, and margins stay strong even as growth slows a little. In the more realistic case, competition keeps chipping at market share. Regulatory scrutiny over caffeine and sugar content increases in some regions. Some markets have already floated restrictions on energy drink sales to minors. Growth settles into something closer to a mature, single-digit pace long term. But even in that scenario, the structural advantages don't disappear. Two Formula One teams, dozens of sports properties, and decades of footage remain. Those assets don't get erased by a slower growth quarter. They keep generating attention long after any single ad campaign would have faded. A slower growth decade for Red Bull still looks enviable next to most rivals. The underlying machine keeps compounding, just at a gentler pace. So what does the Red Bull story actually teach? The can? The sugar? The caffeine? Those are the least valuable parts. Any competitor with enough capital can replicate the formula by next year. What can't be replicated quickly is 4 decades of earned cultural credibility. A Thai energy tonic for laborers became a global symbol of extremity. Not because the liquid changed much, but because the story did. Chalio Uvidya and Dietrich Mateschitz didn't just bottle a drink in 1987. They built a machine that turns marketing spend into permanent brand equity. They proved that owning attention can be more valuable than owning factories. They proved a media strategy can outperform a distribution strategy at scale. And decades later, that machine is still quietly printing money. Not from a smarter formula, and not from a lower price. From 4 decades of convincing people that a can means something. One extreme stunt, one race win, one can at a time. That's the real architecture behind the wings, the cans, and the paddock. A pharmacist's cheap tonic and a marketing executive's jet lag started all of it. Everything since has been execution, not luck. The formula was never the hard part to build. The meaning was, and meaning takes decades nobody can shortcut. That's the gap between a beverage company and a media company with a drink. Red Bull picked the second one, deliberately from the very beginning. And it's the reason a 50-cent can still sells for $3. Not because people are being fooled, because the story genuinely delivers something the liquid alone never could. A feeling of edge, of belonging, of being slightly outside the ordinary. That feeling has a price, and millions of people pay it daily. Coca-Cola built its empire on nostalgia and universal familiarity. Red Bull built its empire on adrenaline and cultural extremity. Different emotions. Same underlying architecture. Brand as the actual product. The can was always just the vehicle. The story was always the thing you were really buying.